Hi friends, welcome to Adda 24/7. We are in the BFM important questions and case studies. Here, we are covering this for all the subjects ABM, BFM, ABFM, BRPL, various mentors. I am covering ABM and BFM. So, watch the video completely, share it with your friends, like the video. Today, I'll be covering important numericals and then the objective questions, of course, both. Case studies means numericals I'll cover and objective questions will be there. So follow the video completely, share it with your friends, like the channel, subscribe to the channel. Okay, let's move on. Calculate the TT selling rate for GBP INR if USD INR is given as 43.85. One second. Is given as 43.85 and GBP USD is given as 1.934549. A margin of 0.15% is to be loaded. So you have to calculate the TT selling rate. So now importantly understand what I mean by this. See, this TT selling rate is always used whenever you are doing the import or export. Type in the comment section, everyone. This is just for information. Okay, whenever you are doing the import, okay, import, you use the selling rate, sell. Why? Because the currency goes out, dollar goes out. Okay, so import we use the selling rate. Whenever the dollar is going out, whenever dollar goes out, okay, then we use the selling rate. So here selling rate is asked. So GBP to INR is asked. So you do it simple. It's a normal cross currency problem. GBP to INR. I'll write it rupees. See, this code system is known as what? Where GBP is constant. This code system is known as, yes, direct. Okay, direct system. And indirect means reverse. So rupee is constant. So here GBP to dollar, okay, dollar into dollar to rupee. This will give you the correct answer. Here, whenever this is known as a chain rule. Chain. Okay. When do we use the chain rule or cross currency? When do we use it? Whenever we don't have the direct rates. So now you are having the rate of GBP to dollar. Is it given? Yeah, see this. GBP to USD 1.934549. So which one will I take? Selling. Selling means right side. So I'll be taking 1.9349. Okay. Into. Now next. USD dollar to rupees. So is it given? USD to INR. See this. So 43.87. 43.87. Now do it, everyone. Give me the answer. Give me the answer, everyone. Fast. Yeah. What is the answer? Even I don't have it. Here, these are the fresh problems which I have taken. So it is 1.9349 into 43.87, right? 87 only, na? Yeah, 7. So it is 84.88. So the answer is 84.88. So is this my final answer? No. Why? So remember the logic. There are 3 steps in any forex problem. First is buy or sell. Buy or sell. Step number 1. Second step is forward points. Forward points. Third step is TT margin. TT. Okay, or we call it exchange margin. So buy or sell, here we have decided sell. So this is sell. Forward points, it is to be done on a spot basis here. So forward margins are 0. TT margin, yes, that is given 0.15%. So this I'll have to use now. So 0.15% means what? See this TT margin, how will I add this? It is like this. 0.15% into this 88.88 into 0.15 the whole upon 100. Okay, so you'll get the answer. So what is the answer? Look at this. 88.88 into 0.0015. Okay, so it is 0.127. So 0.127 or and something more is there, 3. Okay, so take up to 2 digits only. That's okay. 0.12. So what is the final rate now? Now look at this TT margin. Kindly understand one important basic. Whenever you using the selling, okay, selling, For selling, you'll always add. For buying, you'll always subtract. Okay, so here I'll add now. So my final rate equals to what? 88.88 plus 0.12. Okay, so it is what? 89 something? 89.00. Forget this 7. Okay, so 89.00. So this is your final rate. Okay, got it? Everyone clear? Type in the comment section. Okay, move ahead. Second one. A foreign correspondent intends to fund his Nostro account maintained with the Mumbai branch of PNB. What rate is to be quoted if 1 USD equals to 44.2327 and margin is 0.08%? Now look at this. What do I mean by this? Foreign correspondent wants to fund. So this is what, say, this is, let's say, Citibank. Citibank is a foreign correspondent. Okay. So this Citibank wants to fund your, one second. Citibank wants to fund your, okay, this is Citibank. It wants to fund your account in PNB. So this is PNB. Okay. So now what happened? This is Citibank. Citibank. Okay. It wants to fund this account. So once it wants to fund this account, it means for this it is what dollar is coming in. So it will be buying rate. So 44.23. That will be the rate. See here, buying already I have told you in the earlier problem. Left side is buying, right side is selling. So 44.23 is my rate. But is this my final rate? Again, follow the basics which I told you. Buy forward points 0. There are no forward points. Why? Because we are doing this at the spot rate. Whenever there is a bill or forward something in future to be done, then we use the forward points. And margin is given as 0.08%. So multiply this. So 0.08%. So if you multiply this, what will you get? So the answer is 44.23. Look at this. 44.23 into 0.08 divided by 100. Percent it is 100. So it is very less, 0.035. So it is 0.035. So what do I do with this now? This is a buy transaction, right? It's a buy. So buy means you TT margin. What do you do? This is TT margin. So what do you do with the TT margin? You'll subtract. So your answer will be what? Final rate 44.23 minus 0.035. Now get the answer. This is your final answer. Okay. So minus 44.23. So it is 44.19. Okay. So your final answer is 44.19. Okay. This is your final answer. Got it, everyone? Before moving ahead, subscribe to Officers Adda 24/7 English channel as well as Hindi. Join the crash course immediately because days are passing and exams are coming near. Okay. CAIIB Mahapacks. Join this immediately. How to join this? I'll show you at the end. Okay. Don't miss the end. Okay. Now we'll solve some questions, objective questions. Let's move on. Hi friends. Welcome to the Scholar series of BFM. Here we are covering all the important theory, numericals, objective questions, case studies. So join the series definitely and subscribe to the channel. Click on the bell icon, share it with your friends. Okay, let's start. Yeah, first one. Which of the following statement about the correspondent banks is not true? Now correspondent banks is not true. Firstly, what are correspondent banks? Correspondent banks means those banks which act as an agent of yours. For example, let me give you an example. Suppose SBI. SBI is in India. Now, if SBI wants to do some transaction in, let's say, some other country, let's say USA. Now, I'm giving you an example. SBI wants to do a transaction in, let's say, USA. Okay. Now I'm assuming, here I know SBI is having a branch in New York also, but I'm assuming if SBI is not having the branch in USA, but it wants to do the transaction in USA. So what will it do? it will appoint some bank over there, Citibank, let's say example, Citibank as its agent. Okay, it will appoint Citibank as its agent, and this bank, when it acts as an agent, is called as a correspondent banking. Okay, so now we got it, correspondent banking. Now let's look at the options. Correspondent bank provides services as agents for collection of export-import bills as well as checks in their country. Okay, number one. Correspondent bank uses only a single currency for the transaction. Now you want not true. Look at this. You want not true. Uses only a single currency for the transaction. Correspondent bank acts as a middleman between the financial institutions, and all of the above are true. Now we want not true. Okay. So which of them can be the answer over here? Think over it. Everyone think. You want not true. Which of them is not true? See here. Forget this. This option is this. Somebody might say D is not true because all of the above are not true. So forget D. Don't look at D. Okay. D is totally it's irrelevant. Consider between A, B, and C. Which of them is not true? Correspondent bank provides services as agents for collection of export-import bills as well as checks in their country. So, agent for collection. What did I say? SBI will appoint Citibank as its agent. So they'll act as an agent. So that is true. Correspondent bank uses a single currency. What is this logic? There is nothing, no logic of single currency over here. Correspondent bank has nothing to do with the currency. It can use single or multiple currency, whatever it is, depending on what relationships or what transaction is happening. Okay, it has nothing to do with this. So this is false. Correspondent bank acts as a middleman between the two financial institutions. That is true. Okay, so it acts as a middleman is the wrong word actually. Men is the wrong word. It should be a middle person, or you can call it as a liaison. Liaison. Okay, Liaison. Okay, liaison means the person who connects the two. Okay, so got the answer. Answer is false. That is B is the correct answer. Which one is not true? So this is B is not true. UCP 600 defines original documents with more precision. According to UCP 600, which of the following is considered as the original document? What is considered as the original document? Now first, what is UCP 600? Now look at this. In your CAIIB studies, you have almost 5 types of studies or topics for your this module A. One is UCP 600. Okay. Second is ISP 98. Third is URR 725. ISBP also you have. ISBP 745. Now it's not 745. Now it's 821. 821. So these 4 you have. There is one more EUCP, but I don't think so that much is there for you. 2.1. This is the main. These 5 subjects are there for your CDCS exam. Those who want to give some foreign exchange trade, means trade finance, for them this CDCS is important. So mainly you have these 4. Okay, UCP 2.1 is not there for you. So UCP 600, EUCP 2.1 is not there. So UCP 600 is what? UCP 600 is the governing document, or it has 39 articles. It is one of the governing document for the LCs, letter of credits, in international trade mainly. Okay, so it is there for even local LCs also it's applicable, but internationally it's used more. So now let's come to the question. UCP 600 defines documents as original. So which one is original? Any document bearing an apparently original signature, mark, stamp or label of the issuer of the document, unless the document itself indicates it is not original. Any document that appears to be written, typed, perforated, stamped by the document's issuers, means written. Suppose if I write something, so is it original? Any document that appears to be on the document issuer's original stationery, and all of the above. So which of the document will you consider as original? Suppose if you get something like this, you practically you are in the bank, let's say, and you get some document like this. So in that case, what will you consider it as a original? Which one will you consider? Any document marked, stamped, signature, mark, stamp, label, anything which is done. Means there is a document and I sign on it, or I put a original stamp on it. So is it original? Yes, it is original. Yes. Any document that is written by me, written typed by me, means you come to know that it's typed by me. So it is original. Yes. Any document that appears to be on the document issuer's original stationery. Suppose if something is on my original letterhead, then also it's considered as original. So the answer is D, all of the above. Okay. To give you more explanation on this, look at this. There are total 39 articles in UCP. Out of them, Article 17 defines the original documents. Article 17. So Article 17 defines the original documents as any document bearing apparently original signature, mark, stamp, label of the issuer of the document, unless the document itself says it's not original. Means document says it's a copy, then it's okay, then it's copy. Okay. Or any document that appears to be handwritten, that's typed, perforated or stamped, or any document that appears to be on the letterhead of that issuer. Okay. So in Article 17 defines this correctly. Got it? Which of the following is a capital instrument permitted for receiving foreign investment in Indian companies? Foreign investment in Indian companies. Capital instrument. Government. Now Indian company. Okay. We are not talking of government over here. We are talking of company. Government securities, T-bills, equity shares and all of the above. Simple one. Quite simple. This is a JAIIB question, I think so. Isn't it? Right? What is the answer? In the comment section. Everyone type in the comment section. What is the answer over here? It is C, equity shares, isn't it? Here we are talking of company over here. Right? When we are talking of company, company means what? It is limited by shares. So anyone who wants to invest in that company will invest in shares. Okay? Now what are the other options given? Government securities. So this is for the government. Okay, government securities is for the government. Now look at this. I'll give you some explanation for this also. See, these two are generally issued by the government only. Government securities are generally, I tell you, beyond 1 year, greater than 1 year. Means any bond which is issued by the government beyond 1 year is called as government securities. And any bond which is issued by the government up to 364 days means let's say equal to less than or equal to 1 year. So that's called as a T-bill. These are all like the current assets, okay, short-term instruments, and these are the long-term instruments. Got it? But that is for the government. Here we are talking about Indian company. So company means equity shares. Got it? When a bank provides a loan of 1.5 crores in accordance with the RBI guidelines, big question, very big. Loan of 1.5 crores in accordance with the RBI guidelines for a period of 5 years at a rate of interest of 1% over BPLR. So base rate prime lending rate. Okay, base prime lending rate. So over 1% over BPLR of the bank. At present BPLR is 9%. The loan shall be repaid in 4 yearly installments in a 1 year moratorium. With a 1 year moratorium. Okay, 4 yearly installments with a 1 year moratorium. Funding of the loan shall be done from a deposit of 3 years of the same amount. The interest rate being 6%. Okay. What kind of risk is associated with such a loan given? Firstly, have you got the question? There are two things. Okay. One is loan, and second is deposit. Okay. Now for any loan, I need an equal amount of deposit. Simple. Keep it that simple. Okay. So let's talk about the loan first. Loan for a period of 5 years at a rate of 1% over BPLR. So period is what? 5 years. 5 years. The loan will be repaid in 4 installments, yearly installments with 1 year moratorium. So 1 year it is moratorium. I have given the loan today. Up to 1 year no repayment. then in 4 installments, 1, 2, 3 and 4. So total there are 5 years. Okay. So 1 year is a moratorium. Yes. So up to 1 year, no repayment. So now in this case, what do we do? There will be one more, it seems. Yeah, 5. So now in this case, see this. What is the deposit? Deposit is of how many years? Funding 3 years. See this. Deposit is of 3 years. So now deposit is of 3 years. 3 years. 1, 2 and 3. And loan is of 5 years. So what is the risk this bank will be facing? Remaining everything is seeming to be okay. BPLR rate is 9%. So 9 plus 1, 10. The rate is not that much issue over here. So which is the risk this bank will be facing? Funding risk, liquidity risk, reinvestment risk, embedded option risk. Okay, let's look at the rate also. 1% over BPLR. BPLR is 9. So what is the rate of the loan? 9 plus 1. Right? And what is the rate of deposit? Interest being at 6%. So 6% is the deposit. So there it seems to be okay. Means I am giving the deposit at 6%. Okay, means I am paying 6% and I am getting 10%. So this amount is seeming to be okay. Means the rate of interest is okay. Only the problem is of the period. Now because of this period, what type of risk will I face? Funding. Of course funding risk will be there. Why? Because this depositor will come to me after 3 years. Once this guy comes to me after 3 years, from where will I pay that customer? Because this loan holder will give me the money after 5 years. Right? So funding risk I will be facing. Second, liquidity risk. Will I be facing? Yes. What is liquidity risk? I am not able to pay the depositor, the principal, okay, because of the lack of funds. So that is liquidity. So that is also there. Reinvestment risk, that will also be there. How come reinvestment risk? Reinvestment risk means, suppose if I get this deposit over here at 6%, okay, after the end of the 3 years, will I be able to get another deposit at the same rate, or will it be higher rate? So that is also there. Embedded reinvestment. What is embedded option? Embedded option can be there in all the both the things, deposit as well as the loan. Means I'll tell you the simple example. This person, a loan holder, he has taken the loan for 5 years, but this person can come tomorrow also. Forget this moratorium period. This customer will come tomorrow only within the moratorium period. He might come there and tell you that, see, I am having the money now and I want to repay it. So that is known as embedded option risk. Similarly, deposit holder. This deposit is for 3 years, but tomorrow, within 1 year only, this deposit holder will come to you. Sir, this is your receipt and I want my money back. You can't say anything. You have to give the money back. So that is embedded option risk. So answer is all of the above. D. All of them are right. Got it? Why all of them are right? Because all the risks do exist over here. Got it? Next one. Which of the following statements is not true regarding the basis point value of the bond? BPV. Basis point value. What is BPV firstly? Firstly, you need to understand what is BPV. I'll give you a simple example. Simple meaning. Percentage, 1%. 1% divided by 100 equals to 1 BPV. Remember this. 1 BPV. 1% divided by 100 equals to 1 BPV. Clear? So basis point value of the bond is a measure of the price volatility of the bond prices to 0.01% or 1 BPV in its yield. What do you mean by this? In its yield means, look at this, change in the price volatility of the bond prices. Here, always remember one basic rule. If the rate of interest, ROI, let it be in BPV also, let it be in percent also. If this goes up, so in that case, the price of the bond, okay, price of the bond will go down. Always remember this basic. ROI goes up, price of the bond will always go down. They are always inversely proportional. This you have studied it in your JAIIB also, right? Those 11 theorems of the bond. Anyone remembers how many theorems were there? There are total 11 theorems, right? So have you studied those? So one of them was this. I think so. Theorem number 3 or 4 was this. 3, I think so. Yeah. Okay. So we want not true. We want not true. Focus on this. A larger basis point value implies bigger change in the price movement. Larger basis point means if there is a this is 1 BPV, it says 5 BPV. So it means, or it says 10 BPV. So as the BPV goes on increasing, the price volatility, bigger change in the price. So price volatility is higher. So that is also true. So this is true. That is also true. Higher basis point value represents the lower risk to the investor. Higher BPV is lower risk. Is this the case? What do you mean by higher BPV? Higher BPV here means I am having larger fluctuations. Whenever I am having larger fluctuations, what does it mean? It means that my risk is higher or lower. If my BPV is higher, means price change is higher. See, simple. ROI changes more, price change will be more. So my risk will be what? More. So that is false. Okay? Because here it is saying lower. That is the answer is actually higher. Okay? So this is not true. So answer is C over here. Got it? Which of the following statements are correct regarding the value at risk? What is VAR? See, this is called as VAR. Value at risk. VAR. What is VAR basically? What do you understand by this term VAR? Let's say I'll give you a simple example. If you buy a Reliance share, okay? If you buy a Reliance share, okay? So the price of this Reliance share is roughly, I'll tell you, 2500. Let's say, okay? It's not 2500. Let me assume it, 2500. Now the daily fluctuation in this Reliance, either it goes to 2600 in one day or it goes to 2400 in one day. So 100 rupees here or 100 rupees there. So this amount of 200 rupees, 26 minus 24, this 200 is known as my VAR. So this much is my VAR. I have to make the provision, or this much is my risk. But this should be well calculated. Remember this. This is an important part in your module D of your BFM. Also module B it's there, but D is a major part. So remember this. VAR means whatever is the fluctuations here. Entire 2500 of yours is not at risk. Only this 200 is at risk. So here the provisions made are also on 200 only, not on 2500. Got it? That is the meaning of VAR. It predicts the worst case loss at a specific. Now what do we want? Firstly, correct. Okay, which one is true? Specific worst case loss at a specific confidence level over a certain period of time under normal trading conditions. Normal trading. Okay. VAR is for normal or absurd conditions. It considers the volatility of prices and correlation of prices with respect to all other asset liabilities in the portfolio. So which one is true in this case? Think over it. Which one is true? Always remember one basic. That's why I said module D. Module D gives you the much better picture about this. Okay. VAR is always applicable only in normal trading conditions. Means, see here, if my stock market Reliance share is fluctuating like this, so then it's normal trading conditions, lower limit this, upper limit this. But there comes a COVID, and COVID Reliance share goes this. So this part is never covered in VAR. So this is known as normal trading condition, NTC, and this is known as extreme condition. So this is not covered under, it is not covered under this VAR. Got it? So first one is true. What about the second? It considers volatility of prices and correlation of prices with respect to all other assets and liabilities in the portfolio. So volatility of prices and correlation of prices. Correlation means in relation to other elements. Okay, with respect to all other assets and liabilities. So that is also true. Okay, this is true. So the answer is both 1 and 2. Both 1 and 2 are true over here. Got it, everyone? Everyone understood? Type yes in the comment section if you have understood this. Okay, type yes. Understood this? Because these terms are very important for you. You must get this clarity, much clarity about this. Okay, let's do one more. Okay, which of the following is true with respect to the risk mitigation? Mitigation means minimizing the risk. Mitigation, here understand the meaning. Minimize the risk. Okay, so what is true about this? It reduces the downside variability in the net cash flow. Risk mitigation can be done through diversification. It reduces the risk by reducing the probability of occurring. Reduces the risk by reducing the probability of occurring. So what is true about this? Simply, isn't it? See here, first one is true. Reduces the downside variability. True. Downside variability means in my net cash flow, means whatever cash I am getting, it reduces the lower side of this. So if I am getting 100 rupees, tomorrow I might get 98 rupees. But it can't happen that 100 today and tomorrow I will be getting 10 rupees. So that is the reduction. Risk mitigation can be done through diversification. True. So once you know two are true, so it means almost all of the above, isn't it? Third is obviously true. It reduces the risk by reducing the probability of it occurring. Okay. So the answer is all of the above. Okay. So as I told you before going, I'll be showing you how to join the batches. Okay. See, your batches are very important. Let me show you. Go to Adda 24/7. Here. Always go through the app. In the app, you get 1% extra using the coin systems. Okay. Go to Adda 24/7. Click on JAIIB and CAIIB. Click on CAIIB November. Okay. See this crash course. Join this crash course, English one, immediately. Okay. Ebooks, test series, online live classes, expert faculties, everything you are getting. At what cost? Look at the cost. Click on buy now. Put the code Y432. Never forget this code Y432. Okay. Y432. Click on apply. 77% discount you are getting plus 1% using the app. So don't miss it. Okay. Also, if you join the Mahapack, in Mahapack you are getting multiple batches. 15 plus batches per subject, and that also 3 various validities you are having. You can choose your own. Again, don't forget the code Y432 to get this